All right. Hi, everyone. Welcome to day two of the 20 Fibonacci and Elliott wave trading strategies here on TimingResearch.com. Have an excellent lineup for you again today. And of course, just a reminder, all of these presentations are for educational purposes only. Trading is not suitable for all people. And please consult a financial advisor and only trade with money you can afford to lose. And um, I'd like to welcome Sid Norris of ElliottWavePlus.com to be our opening presenter today. So, Sid, I'm going to go ahead and turn over to you.
Thank you very much, David. My name is Sid Norris. I am the owner and primary market technician at ElliottWavePlus.com. And good morning to everyone. This is the timing research presentation. Um, I'll be here for 1 hour, and today is September 26th of 2025. And the title of my presentation today is Out with the Old and In with the New, the Great Rotation Underway Now, from bubble stocks to commodities. Um, Before we get started, I want to bring over my website so you can see what it looks like. It is ElliottWavePlus.com. And you can go there and rummage around. There's a picture of me, kind of an old picture. And there's information about my plans and things there, and that you can register to receive notification when I put out new blog posts there. But right here at the beginning, I want to show you the terms of service disclaimer at my site. It's there all the time. So you scroll to the bottom of any page on the site and click on that tab, and it's there. If I were to summarize it in one sentence, it would be there's risk of loss in all trading. So I want to start the presentation today with some ratio charts. And I like to start with this one every time, as I believe it is extremely informative about what really is happening with your money and your investments in the stock market. So this is the S&P priced in gold. And as you can see, the all-time high is still easily standing from way back in the year 2000. And the amazing thing about when you show these ratio charts of just about anything priced in gold, real money, is that you often get really clean, clear Elliott wave patterns. And the reason is because is that it's priced in real money. When you price something in the US dollar, which the value is constantly shifting and frankly, most of the time shrinking, then it bends the mirror and distorts the actually what's going on. And so in a lot of these ratio charts, I'm going to show you a number of technical charts of things priced in gold and things priced in oil. And so we're starting with the S&P priced in gold. As you can see, the year 2000, there was a five-wave down structure, clear as a bell. And within the third wave, there was five waves down there. It's rather perfect in a triangle for the fourth wave. And then the rebound starting in August of 2011 started with a five-wave structure, and I'm labeling that as a wave A of a zigzag, and then a B, and then a rather short wave C of an upward corrective pattern, a zigzag through December of 2021. And ever since then, we're embarking on a very bearish looking situation. And we're very likely very near the wave three of three down in the stock market. Um, Needing a five-wave down structure, a C wave of an eventual A, B, C zigzag. So this is amazing because just a few days ago, the S&P made new all-time highs. But those new all-time highs were priced in US dollars. And this just shows that if you're sitting long the stock market and hoping that indexing, just staying long the index, is going to make you rich. The value of your account has been going up, but the actual spending power of your savings when using that methodology have actually been shrinking ever since the year 2000. Now, today's presentation is about a grand rotation that I believe is starting from what has been holding up the stock market and into what I believe is going to be a strong bullish investment over the next few years. So this is a ratio chart of FANG stocks to the IXC ETF. So IXC is kind of like XLE. It's energy stocks, but it includes not just the U.S. Headquartered energy stocks. It's got several energy stocks included in the ETF from around the globe, like BP, Total, Shell. All of those being either British or European. And you can see up from the November of 2022 low, we got a really clean, clear five-wave up structure. But here's the most important thing on this chart. It's this huge bearish divergence um, that I refer to an Elliott wave as a 3-5 divergence. So, and when you have a five-wave structure, you almost always have a divergence where the fifth wave makes a new high, but the momentum indicator cannot make a new high. That's textbook 3-5 bearish divergence in Elliott wave, and you can see it's rolling over here. And this indicates to me that we're going to see a rotation out of the what's been leading the markets, which is the Mag 7 stocks and the AI stocks, into energy stocks. And then the next slide here is this FANG stocks, very similar chart, priced in global natural resources ETF. So the FANG stocks have just been ripping higher, and everyone's real excited about them. But you can see from November of 2022, 1, 2, 1, 2, 3, 4, 3, 4, and then the fifth wave, 1, 2, 3, 4, 5. I've even got a Fibonacci target on here that is one that I often use, always use as my primary Fibonacci target for the end of a fifth wave. And so for that, I take the net traveled of 1 through 3 times 0.618 and then add that to the wave 4 low. So this would make wave 5 equal to the net traveled of 1 through 3 times 0.618. And I always do that on a semilog or logarithmic chart, and I make sure that the Fibonacci tools are using logarithmic math. Just FYI, that I use Trade Navigator by Genesis, another popular platform that will draw the Fibonacci's and correctly using logarithmic math is TradingView. But amazingly, some of the very most popular platforms out there will not do that. Like, for instance, Thinkorswim. You can set a chart to logarithmic, but the Fibonacci drawing tools still draw in regular linear math, and that does not give you the correct Fibonacci targets. Here's so you're thinking, well, that's FANG stocks, that's the Mag 7 stocks, but AI is the real winner here. Well, let's see. How about from November of 2020? 1, 2, 3, 4, 5 wave down structure, followed by an A, B, C zigzag. All the subdivisions are there. And up from October of 2023, 1, 2, 3, 4, 5. It's looking real toppy. We have a large divergence showing at this most recent peak in AI stocks when priced in global energy stocks. This chart is commodities as a group priced in the stock market. So the April 2020 low, as you may recall, the front month contract of crude oil went negative for a little minute. And that was the all-time low over the last 100 years in commodities in comparison with the stock market. Then there was the inflationary blast up through middle of 2022. And from June of 2022 through the end of 2024, we had commodities moving lower when priced in the stock market to sort of a long-term double bottom on December 2024. And then this year we've seen commodities break out of that downward channel. And I believe what we're seeing here is a 1-2-1-2, and we're going to see commodities moving forward much stronger than the stock market. This is why I'm saying out with the old and in with the new. The old is the basically the bubble stocks that have been so popular, also Bitcoin, and I think we're going to see a rotation into commodities. And all of these charts support that concept. This is crude oil priced in gold. So, and once again, we get a really clean, clear Elliott wave pattern of 1, 2, 3, 4, 5, an impulsive move up from April 2020 through June of 2022, followed by an ABC zigzag. The subdivisions are very nice. 1, 2, 3, 4, 5 for A, B, C for B, and then 1, 2, 3, 4, 5. A significant bullish divergence showing on the RSI here. This is suggesting that as strong as gold, and gold has been incredibly strong, especially this year. And it's been super strong in comparison with the price of oil ever since June of 2022. But it appears that we are very near a bottom, including a bullish divergence there. And we could see crude oil, energy moving up much faster than gold moving forward. How about oil stocks? So this is the XOP ETF, the crude, basically oil and gas exploration and production ETF. And you can see up from the March of 2020 low, 1, 2, 3, 4, 5 for A, and then an ABC for B. And now it looks like it's bottomed and giving us a 1-2. If this chart is correct, and I believe it is, and I can support the concept with Hurst cycle analysis and will during the webinar here, we need a C wave to the upside, a 5-wave up structure, a companion 5-wave up structure to this 5-wave structure here. So this would be a zigzag 5-3-5 in Elliott wave. So we could see XOP move from its current price or move up. I know this sounds crazy, but over 300, almost 400% over the next 2 or 3 years when priced in gold. This also supports the concept that energy is, which is lagged gold, is in position to catch up. Here's the stock market priced in crude oil. So starting so I think we got a 5-wave down structure from April of 2020 through June of 2022, and that's been followed by an ABC zigzag, a corrective structure to the upside ever since, a 5-3-5 structure. Within the final 5-wave structure up from approximately October of 2023. We got a 1, 2, 3, 4, and then the 5th wave up here, an expanding ending diagonal, probably topped. Look at this massive bearish divergence on the weekly chart. I think we're going to see crude oil much stronger than the stock market moving forward. This one's interesting. This is gold priced in natural gas. And so This also uh, suggests that as strong as the metals have been recently, the precious metals, we're likely to see a rotation into energy, not only crude oil, but natural gas. So, gold has been moving up this year against natural gas, but it's been moving up in a three-wave structure. Interestingly, starting in March of 2024, I think we've got a leading diagonal five-wave structure for wave one and followed by a deep ABC zigzag. And here's another Fibonacci tool that I like to use, and that is we have a wave A, and I'm expecting a C wave, an ABC. I would look for wave C to be a 0.382 expansion of A. So in this case, we would measure wave A, consider that a unit of one, take that times 0.382 and add that product to the top tick of A. And you come up with this target here, and it went exactly right to that target, and now is creating a bit of a head and shoulders there. This is very bullish for natural gas and kind of suggests that we're probably at an interim peak on um, gold. So that, let's move on now to, um, and we'll close that out, the stock market. The stock market. First, before I show you my wave count on the S&P, I'll show you some interesting phenomena on the market internals that have been going on recently regarding the stock market. So this is the advanced decline ratio. This black line right here is a 13-day exponential moving average of the daily closes. And the advanced decline ratio, it's smoothed out a bit, has been declining, putting in lower highs ever since early July. But look at what the stock market's been doing. Rip roaring higher during July, August, September timeframe. And notice that it just broke a support line connecting the most recent lows. And so this is bearish. It is bearish the stock market. It's actually rather amazing that the stock market was able to put together that kind of rally on a weaker and weaker advanced decline. In other words, fewer and fewer stocks were leading this market higher as it went on up. I've got additional support for that concept I'll show you. Notice also we're getting lower highs on the momentum indicator on the advanced decline ratio. Very weak into that high. So this, I think, is just the beginning of a larger correction. Also, recently, the cumulative advanced decline line, which is the red line here, had a couple of times here recently, has shown us bearish diversions. It almost never, ever does that. It generally pretty much just follows price. So we had a bearish divergence that led to that pretty that 16% sell-off in the S&P. The black line is the S&P. Back in that was in April. And now we're starting to see the lower highs on the cumulative advanced decline line at the same time as the stock market's been ripping higher. Also, notice this money flow index versus RSI indicator. The RSI is in black. The blue is money flow. Um, and you'll see in a second what kind of magnitude of downward movement I'm expecting when I show you the S&P chart. But thank you for that question. I always keep an eye on the chat for questions, and that's a very good one. Thank you. But notice the volume plummeting, even as so this is the money flow indicator is basically a volume weighted RSI. You can see the volume just escaping from the balloon, and as it went on up recently. This, I think, is a very instructive chart, and the purple line is the ES contract. It's the market cap weighted stock market. The black line, or the market cap weighted S&P 500. The black line is an equal weighted S&P 500. And notice that up from the October of 2023 low, the equal weighted was strong. This was a strong rebound or strong rally, and was inclusive of a lot of stocks in the S&P, starting at October 2023. But then we had the decline down into early April, and ever since then, especially starting in early August, we saw an incredible phenomenon where the market cap weighted S&P, in other words, the largest stocks in the S&P, are giving much more weight. Just completely, here's just recently this month, was outpacing the equal weighted RSP by an unbelievable amount. And so it was just very, very few stocks that was holding this stock market up. And notice, I took this yesterday, this screenshot yesterday, that the all-time high at the time on the equal weighted RSP, equal weighted S&P, was occurred on November 29 of 2024. And we did see some ever so slight new highs on the equal weighted S&P recently, but now yesterday it closed back below that high from November 29 of 2024. And it just goes to show how incredibly narrow this market has been in recent here this month. So this is my wave count on the S&P. And so I'm not showing you here the my longer term wave count because I don't want to the scare you too much about the overall stock market. But it's I think that we just are in the process of seeing now, and may have seen, an incredibly large cycle peak in the overall stock indices. And so notice that this black wave four here in March of 2020, so that would be the end of a wave four of a five wave impulse that actually started back in March of 2009. In the case of the NASDAQ, it started in November of 2008. As a matter of fact, the NASDAQ count is a little bit different. The rally really has been underway in five waves ever since the late 2002 low. So this will be the fifth wave up since in the S&P since March of 2009. And the fifth wave needed to carve out five waves, and it has. And have been calling this, referring to this as a um, ending contracting diagonal for quite a very long time. As a matter of fact, here is a YouTube video. It's the last major YouTube video that I put up at my YouTube channel, which is called Elliott Wave Plus. And so this recording was from April 19 of 2025. And so on when I did this webinar for my Pro Plan and Premium Plan subscribers, it was about a 4 hour long webinar because it was very exciting. I expected that April low was going to be a very large cycle trough, and you could buy darn near anything, just about anything, and it would go up this year. And so my April 19 roadmap was expecting an upward movement in an ABC zigzag through late in this year. This particular one, the Hurst cycle analysis was basically at this time expecting it to move up through December 4. Now, what happened pretty shortly after is Hurst decided that the 4.5 year cycle trough, which really wasn't due until May at that time, actually occurred 1 month earlier in April. And when it decided that, Hurst cycle analysis. It pulled this backward, and it was expecting a peak more like in early October. So this was my wave count way back in April. And here's the way it's turned out. Ending contracting diagonal. The thing I was expecting a little deeper wave B and A, B, C, and so each leg of a diagonal is an A, B, C zigzag. But it turned out that the move to the upside was rather one way-ish and just didn't have hardly any kind of dip for the wave B, a pink wave B. But still, it moved up. And notice that my target way back then was the same. It was 65.10 back in April. And we managed to overshoot that just a little bit here recently. Typically in an ending diagonal, you get a 1, 2, 3, 4, 5, and the fifth wave will throw over a line extending from the extremes of 1 and 3, which it did do, a textbook. And notice that the Hurst analysis is bearish pretty much during the entire fourth quarter this year. So I think all the hopes of a Santa Claus rally and all of that is just going to be dashed this year. I think we are at or near that peak, and we're going to move down into late December next, and then next year really gets nasty. Moving down through the next 18-month cycle trough, which is due in approximately August, and almost everything. I'm going to just represent to you that this same pattern is and general expectation of a bear market down next into the third quarter next year is rather universal. Dow Jones Industrial Average, NASDAQ, all of it. And really that's not all of the bear market. As a matter of fact, as you can see here, I'm calling this recent peak a grand super cycle, wave 3 peak. In other words, the end of 5 waves up from the 1932 low in the stock market. Here is the Hurst analysis. Just did this yesterday on the S&P, and it's projecting that we might have a few more days of up through October 4. And I've got to tell you, I doubt that happens. I doubt we have any more new highs above what we've already seen. We've already seen some bearish, and then down into late December, up into February of next year, down into August of 2026. That's your 18-month cycle trough. A rebound only through the end of 2026, and then more bearishness. This is her cycle analysis in the Sentient Trader software, and it's giving sell signals here out the wazoo. So that is what I wanted to show you associated with the stock markets. And so that might scare the bejeebers out of just about anybody about investing in stocks, but that's not my message today. My message is that I think what we're going to have to do in order to find buying opportunities in the market is it's going to be a more narrow market about where the opportunities are coming. And I think generally, as I showed you in some of the earlier slides, that those opportunities are going to come from commodities. So now what I'm going to show you next is the Mag 7 stocks. I'm going to run through the wave counts very quickly. I think we have a peak in December of last year from Apple, and a 1 and a very deep wave 2. Hearst is bearish on Apple down through basically year end up into April of next year, and then more bearishness after that. Amazon's starting to give way in what looks like the beginning of wave 3 to the downside. I think I've been projecting that this high back here was going to hold, and it did. And we did get a very deep retrace here. But this is bearish wave count on Apple. Google On Google, up from the March of 2020 low, I think we got that same pattern that we've gotten in the S&P, but we just got a larger throw over of this ending diagonal, and throwovers are normal at the end of a contracting ending diagonal. Hurst is bearish down really all the way through late next year on Google. Meta, it's Hurst thinks Meta hadn't quite topped yet. It's still kind of hovering up here, but it's expecting a top within a couple of weeks or so, and then a bearish end of this year up into April next year, and then more bearishness. And so, no, most of these, the roadmap moving forward is quite similar, not always identical, based on her cycle analysis. Microsoft, I think, is top. Amazingly, Microsoft, when they announced and said they were going to pour an unbelievable number, hundreds of billions of dollars into AI data centers, the stock popped 10%, and that marked the high. And this is generally a bearish roadmap for the rest of this year, up into May of next year, and then more down. NVIDIA, I don't think it's topped yet. I think NVIDIA needs a fifth wave up here, and Hurst agrees. It's suggesting that it will put together this final fifth wave up from this low back here, 1, 2, 3, 4, 5, up through October 2022. Tesla. Tesla recently, I think, has finished in a corrective upward pattern. So I think this downward pattern here was impulsive. And then we got an A triangle for B, or it could be a W and an X. A terminal thrust from that triangle, likely topped on Tesla. First is bearish now through year end, up through the middle of next year, and then more down. And there's the Mag 7 stocks. So, what's next on my presentation here? It is gold, silver, and the US dollar. So, I'm going to run through the gold and silver counts real quick, and then I'm going to look at the energy. So I'm already getting a comment from someone saying, really bearish outlook. I'm just telling you that these Mag 7 and AI stocks have been in a bubble. It's unsustainable. And I believe that there's a rotation. This is the whole point of today's presentation, into commodities. And so we're going to start looking at commodities. Notice that gold, how incredibly strong gold has been. This is my monthly wave count on gold. And I don't think it's topped yet, but I do think it's time for a pullback. So up from the July of 1999 low, 1, 2, 3, 4, and we would be in a fifth wave. Fifth waves in gold and commodities, as a general rule, are aggressive waves and can be extended, and this one is extended. Looking for a very extended target up here, eventually up at 4,900, but up from December of 2015, a black 1, black 2, black 3, black 4. So now we're in the wave 5. I'm expecting that to subdivide into 5 blue waves, blue 1, 2, 3, 4, 5. Hurst thinks it's time for a pullback on gold. It's quite overdone on this third wave, but after that wave 4 pullback, which I currently have a target back to the wave 4, 1 lesser degree, back to 2541, then I think we move on up to about 5,000. Here's the weekly chart. So once again, this low back here is December 2015, but the black wave 4 low is November of 2022. Then we have a blue 1 and a blue 2. So starting, there's your black 1, 2, 3, 4, and there's your blue 1 and 2. So this has all been a third wave to the upside, and so it's quite aggressive. 1, 2, 1, 2, 3, 4, 3, 4, and then a fifth wave. 1, 2, 3, triangle for 4, 5. That triangle is important because in Elliott wave, the triangle, our triangles are followed by a terminal thrust. In other words, it's the final move. out of a the whatever aggressive move that moves up out of a triangle. This is the final move of the pattern. And Hurst is bearish on gold next through March 20 next year. We also are real serious here at Elliott Wave Plus about sentiment. And I have proprietary weekly and daily sentiment charts that I send out to premium plan subscribers. The weekly, they get the weeklies weekly, and they get the dailies every night, and they show the comparison between commercials positioning and retail positioning. And what we look for here at Elliott Wave Plus is we look for situations where commercials are um, like right here. Commercials are heavily long, so this is a 12-month look back on commercials positioning. When it's the green zone, that means the commercials are positioned as long as they have been, as bullishly as they have been at any point in the last 12 months. So who are the commercials? Well, they're the gold miners. It's their job to understand everything about the gold market, but it's also their job to hedge against downward movement in the price of what they are producing. And so at this juncture back here, when gold was back around below, in the 1700s, the commercials believed that it couldn't, it was very unlikely to move any lower. And so they were not hedged. At the same time, retail traders right here were deadly bearish right here. That is what we call a perfect storm of bullishness. Commercials heavily long, retail heavily short. And retail is notorious for being dead wrong all over on the wrong side of the boat at major turns. And you can see how strong the move has been out of that perfect storm condition right back here that occurred back around August to September timeframe of 2022. But right now, the commercials all of a sudden have put their hedges back on right here. Just this is brand new news. At the same time, retail traders recently were very, very bullish. Right here, the 84% of retail traders were heavily bullish. So this has turned into a perfect storm of bearishness on gold, suggesting that we're going to get a correction back in gold. So, as I mentioned, I am expecting a blue wave 4 correction, but then a fifth wave up higher after that. So on to silver. Silver, a lot of people are incredibly bullish on silver, and I'll talk about that here, but I think silver will be stronger than gold. Um, for a little bit, but not as strong as some of the mega silver bulls. This is the Hurst cycle analysis on silver. Expecting a peak within a few days, October 4, and a pullback during the month of October, but then more upside into mid-November. The next 40-week cycle trough on Hurst is due around Christmas. So we could get a bit of a kind of sideways price action here through the end of the year. That's going to make sense when I show you my prognosis for the U.S. dollar, which is for the U.S. dollar to rebound through year end this year. But so there's the Hurst. So the long-term account on silver, just like gold, really expects that we need a 4 and a 5 still to go, in this case up through June of 2006. Now, a lot of people are making a lot of noise about this being a cup and handle. So cup and handle pattern is something that from the Edwards and McGee book, it's a rather ancient technical analysis book. Um, I am way more an Elliottian, and then I use Hurst cycle analysis, and Hurst thinks that this thing, peaks in June of next year, and then is bearish. So I think the best wave count is that matches Hurst is that what we're seeing here is an ending contracting diagonal. that we had the big wave one back in 1980, two down through the early 90s, three up through 2011, four down through 2020. And now we would need an A, B, C. So each leg of a diagonal is typically an A, B, C zigzag. And so an A, B, and we'd be in the five-wave up structure from this low on silver, that burgundy B low. This is the uber bullish silver count. It's very popular. And there's several large major services that are I would have to categorize as permanent precious metal bugs, gold bugs or silver bug. They're extremely bullish on this, and so they think that we have seen either a series of 1-2-1-2s, and now we're breaking higher, and this is no joke. Some of them have targets up here at $800 an ounce on silver or $1,600 an ounce. Now I'm tracking this count, but I don't believe it's going to be correct. And you know why? It's because the world doesn't really need silver that bad. Not bad enough to pay $800 an ounce for it. I'll tell you what the world does need desperately, constantly, and is addicted to, and that's oil and gas. And I'm just not buying off on this super bullish count on silver. So here's the weekly count on silver. Basically expecting a corrective wave four down through year end, and then a major top. I've got a target up here around 53.60 an ounce, $53 an ounce, maybe slightly higher. So this would need to be an ABC zigzag, typically would throw over a line extending from the extremes of uh, 1 and 3. So we're likely to get up to that level, but find resistance at that level. And don't forget, if you try to mimic these charts on your platform, make sure you're on Similog charts and using Similog drawing tools. U.S. dollar. Generally, the long-term outlook for the U.S. dollar is bearish. But on the short term, I think what we're getting is an A and a B, and I think we'll get a much lower dollar over coming years. But it's going to subdivide at a five-wave structure, and I think from this low or this high at the beginning of this year, we got a 1, 2, 3, 4, 5 wave down structure. Now we're going to get a bounce. Hurst believes that this bounce will take us basically all the way through the end of the year on the U.S. dollar. This is supported by Hurst sentiment. This is a weekly sentiment chart on the U.S. dollar. Notice commercials are heavily long. Retail recently quite bearish at a 20. This is a perfect storm of bullishness, and I think this rallying U.S. dollar is going to do much better or go quite a bit higher through year end. So let's go. Now we're going to move to the kind of the point of the webinar, which is the index. And I'm just continuing to get asked about the NASDAQ. Forget about the NASDAQ. Forget about it. The NASDAQ's been an incredible bubble, and I'm bearish the NASDAQ. I'm talking about a rotation, a massive rotation out of what has been bubblicious and into what's going to work. That's the point of this presentation. This monthly chart really exemplifies exactly what I think is going to happen in commodities. This is the Goldman Sachs Commodity Index. So there was a massive plunge down into March, April of 2020. And that was a corrective three-wave pattern. So I think we're in I'm going to call that a very large degree wave A. And so I think we're in a B wave to the upside. And that B wave started with 5 waves up. This is huge. 5 waves up from the March, April of 2020 up through early 2021. And this is on commodities as a group. That was followed by a clearly corrective ABC pattern that came back approximately to the wave 4 one lesser degree textbook. That C wave of that corrective pattern was an ending contracting diagonal, and that would be the final wave of the pattern. So I think this is going to be a 5-3-5 zigzag. Well, when I set up Fibonacci targets on this, I've got a couple of them up here. One is a 0.382 expansion of wave A. So this would be the length of wave A. Consider that a unit of one. Take it times 0.382 and add that product to the top tick, and you get this up here, way up here. And then above that is where the B wave of an expanded flat would be a normal 1.382 times the net traveled of wave A. And you could see that's expecting a big, big 5-wave impulse to the upside over the next few years. So this is the Dow Jones Commodity Index, and we're down to a weekly chart. And if you go back to the January of 2016 low, we were in a 5-wave impulse to the upside on commodity index 1, 2, that's April of 2023, March of 2022, 4 down here. And now you'll notice that it's starting to pick up and go to the upside. I think there's more upward movements ahead of us over the next couple of years, and it could be a blow-off move. There is a website I'd like to recommend to you. They don't pay me. I don't even know them. I don't talk to them, but I think they do good science. And it's a website called Gorozen.com, Gorozen. And they talk about they are experts and do all of the fundamental research into natural resources. And there's their latest commentary. They've got a bunch of good commentaries on there. And they believe that we are going to see this rotation I'm talking about out of what they call the carry trade bubble stocks like Mag 7s, FANGs, and um, AI stocks into natural resources, and they believe that that all of this new tariff business is marking a new monetary regime change, similar to going off the gold standard. And they've gone back in history, and every time there's a monetary regime change, um, it usually happens after the stock market has bubbled way up, and commodities are dramatically low, and then you get this rotation into commodities. It's great reading. Check it out, gorozen.com. So this, I already showed you the Hearst cycle analysis and how bearish it is on the stock market, and Hearst cycle analysis completely agrees with what I've been explaining in this webinar, that we're going to see the stock market as a group, as an overall index, weak, but at the same time as we're going to see commodities very strong moving forward. This is the rotation. And you can see that when I do Hearst on the Dow Jones Commodity Index, it's bullish on next all the way through October of 2027. And it won't move in a straight line. And so here's my crude oil count on weekly. This also is based on a Hearst on crude oil. And you can see it's bearish for the next 2 or 3 years up through late 2020. I'm sorry, it's bullish through 2027. There's your 5-wave up structure from the April of 2020 low, followed by your ABC corrective sideways pattern. And now, and here's the big deal. Hearst is calling this low in April a 9-year cycle trough. It's huge because now we're into a new 9-year cycle. So the first few years of that cycle should be quite bullish. This is supported by sentiment. So this is the commercials versus retail sentiment on a weekly chart on crude oil. Notice the commercials are heavily long. These are the producers of crude oil. They are positioned as if crude oil, if it did move any lower, it not much. They're not expecting it. They're not afraid of it but declining much here. They have taken off their hedges. At the same time as back here in May, with only 13% of retail traders were bullish. That's a perfect storm of bullishness, and it's still developing, and I think will develop to the upside. Here's a chart of natural gas versus bullish from August of 2025 all the way through September of 2026. Yes. Now, this is the 067 contract on Trade Navigator. It's back adjusted to fill all rollover gaps, but this gives a really clean, clear Elliott wave structure. 1, 2, 3, 4, 5, followed by an ABC deep, and should see natural gas wake up to the upside. Here's the exploration and oil and gas exploration sector ETF XOP. This is the Hearst analysis of it, and you can see it's bullish through the third quarter of 2027 next. So this is what I'm saying. The action is not going to be in the indices. It's going to be in commodities, and some of the commodities have already blasted to the upside. The precious metals, especially, also uranium. I'll represent to you, but back in March of 2020, I, in a webinar, recommended buying CCJ stock when it was below $7, and it's gone up over tenfold so far. CCJ is the second largest producer of uranium in the world, a Canadian company. And I think what we've got here is a 1 and a 2, and now we're in a wave 3 to the upside. Eventually, uranium is going to be the energy source. It's the only, frankly, energy source that's got enough giddy up, enough punch in order to supply the power that's going to be required in the global future. The problem is, though, they're going to have to build a lot of plants, and they're going to have to build a lot of these small reactors. They're nowhere near built all the way up yet. So, short term, I'm looking for a pullback for a couple of months on uranium stocks, and there should be a massive, awesome buying opportunity if you're late to this game, starting in February, according to Hearst, and up for several years after that. And then finally, I thought you might like to see a couple of charts on Bitcoin. This is Bitcoin priced in the S&P, and you can see a completed five-wave up structure in Bitcoin when priced in the S&P. I think the Bitcoin is going to be weaker than the S&P. I also think that Bitcoin is going to be profoundly weak when priced in gold. You can see that same five-wave up structure in Bitcoin through this high early this year, and a 1 and 2 and a huge move down. Also, you can see all of these bearish divergences that have stacked up in Bitcoin when priced in crude oil. Here's Bitcoin priced in XLE, that same 1, 2, 3, 4, 5 wave structure. And within this final fifth wave up, 1, 2, 3, 4, and then 1, 2, 3, 4, 5. Um, yeah, I like it. You can buy just about anything in uranium starting in February, I think. As a matter of fact, if you're already in uranium, and you got in low, like when I suggested back in March of 2020, then I don't recommend. I recommend sticking with the trade. I think that Bitcoin is going to collapse. It's going to reveal itself of the as a fundamentalist massive, the bubble of all bubbles for the entire humanity, the length of time of humanity. It's going to collapse. I believe Bitcoin will eventually go to zero. Think about it. It's antiquated. It's slow. It's so slow. It can't act as a global currency. So what is it? So a bunch of smoke has been blown up everyone's rear end about how it's a store of safety. Hmm. What? I just can't. I can't. It's just amazing. I believe it's basically been a psyop. It's been a brainwashing exercise. So this is the company that's basically been manipulating Bitcoin higher, and you can see how weak this is starting to look. And the roadmap on Hearst and everything is profoundly weak moving forward. This whole Bitcoin mania is uh, in bad trouble. And if you made money on it, great, congratulations. But I think the party's over. We're starting to get to the end of this thing. I will show you very quickly our half price offer. If you've never subscribed at Elliott Wave Plus before, contact me. My email is sid, SID, at elliottwaveplus.com. You can also go to Elliott Wave Plus and use the contact form that is available at my website, elliottwaveplus.com. If I can get this pulled over here, there we go. So you scroll to the bottom and you've got the contact us. You'd contact me and say it's like, hey, this is so and so. I'd like to try one of your services, and like to get a 50% immediate 50% refund from you on my first month. And the pricing page is right here, elliottwaveplus.com/pricing, and it talks about the different tiers of service that we have. Um, so I believe that is everything I have, David. If you would like to take back over.